Ueda announcement clearly caught a lot of people by surprise. What does it tell us about the exit from the extraordinary policy that the BOJ has been pursuing? And does it tell us less about the sort of the move that is coming and more about the timing of that move? I'm just kind of wondering how we should interpret all of this.
Well, I think part of it is there's a huge surprise factor. This was on nobody's short list. So I think a part of it has to do with the policy trajectory based on the fundamentals. And those fundamentals are quite clear. One is inflation is quite strong in Japan. Across all the countries that we track, the trends in inflation are higher than any other country in the world. And if you kind of think about what's going on locally, if you look at the Tonkan report, there's significant price pressures and they're very broad based. And that's hinting towards the Shinto wage negotiations are going to be quite high as well, which is basically a confirmation that the problem is solved and it's kind of move on with a new policy. The other side of it is the sustainability of maintaining yield curve control when rates want to continue to break out of the range that they're being kind of repressed into. So it's a self-defeating policy at this point because it's costing lots and lots of money. So I think the way that the market's interpreting this is kind of like now, regardless of who's there, we know the underlying conditions of what needs to happen next. And what needs to happen is the policy normalization needs to continue. Mm-hmm. I would lean in the camp that March is wide open because we got a surprise in December and we can basically just recalibrate to new policy settings before the new governor takes over in April. So March to me is very live and it's very bullish for the yen, the way the market might want to trade it.
Hey, Mark, I don't get then why dollar yen's trading at 131. I mean, we're off the lows. What gives?
Well, part of it, too, is so there's a couple different factors that like there's the internal factor. That's the BOJ factor for the yen, which is quite important. We know that it's undervalued and it should be higher. And we also know that 10-year JGB rate should be higher as well. I think part of it has to do with kind of market positioning. One thing is we're kind of seeing this tension, and we hear a lot from client questions, is like our positioning models are still showing the dollar is very short. So there is scope here. The dollar's tried to build off of the NFP gains last week. And it's also, we don't know markets really understanding what the next move is. I'd say positioning is one side of it. But if you think about it, yen is basically trading in a 132 to 127 range. So the key factor for the next week, besides the nomination itself, is going to be the U.S. inflation report. Mm-hmm.
OK, we'll come to that in just a moment. I want to ask one more question on the BOJ story, if I could. Mark, does the BOJ, as it makes this pivot, need a weaker yen in order to provide cover for what they have to do elsewhere? And are they going to try and make that happen? And I'm wondering what a weaker yen looks like to the BOJ.
Yeah, I think at this point they don't need the weaker yen. It was there. I think if you think about what the framework was for last year, why they were reluctant to move while everyone else was moving, is they really couched it in terms of gross national income. They really focused on that. If you think about it, Japan is a massive importer of energy, along with the Eurozone and along with countries like Korea. So the terms of trade shock that happened last year, the BOJ took an approach that we're not looking at the output gap per GDP. We're looking at it as gross national income. And this is a massive income shock that they went through because the cost of energy and the cost of things they were importing went through the roof. So they wanted to stay on hold to provide a cushion in easing monetary policy and kind of, easing monetary conditions as a function of the energy shock. They just took a different approach than everyone else. Mm-hmm. And now that I feel like, again, they've got wages higher, that inflation itself is more sustainable now that negotiation wages should be higher in real terms. So with all that in mind, the fact that the yen is extremely undervalued, I think if it gets stronger from here, it doesn't really have a negative impact. It could also limit how much inflation can move because you still need to anchor it on the upside as well, which is what they're going to try to do this year.
Hey, Mark, what is the knock-on effect, though, right now that we can look at in terms of the bond market? If repositioning happens, et cetera, we're looking forward to March, how does that affect bonds?
Yeah, definitely it has an impact on treasuries. So, JGBs go up, it's kind of taking everything else with it. It's kind of it's also a function if you think about how things were working in Germany with ECB. ECB is likely to be more hawkish than the Fed. So 10-year German bonds and JGBs are likely to be driving U.S. treasuries at this point. And also, again, if we do move to the side where the BOJ is reluctant to move, they have to continue to purchase more capital to basically maintain that peg, which means it has a knockoff effect on treasuries. So basically they're selling treasuries, and that would also have unintended consequences for the U.S. Treasury market if they tried to maintain yield curve control. So I think at the very least, like the path of least resistance here is definitely probably a steeper curve, at least in Japan, coming from the 10-year side.
Okay, let's talk about that CPI print next week. The anticipation is that we could see a pickup in inflation in the United States. Mark, to what extent is that already priced into the dollar? What would surprise?
Yeah, the surprise factor is going to be very big. Everyone should be focusing on the month-over-month core numbers. Market expectations for around 0.4. I think your playbook is anything above that is really going to scare the market. As I just mentioned a little bit ago, market is really short the dollar. So this is where the dollar gets a little bit of its mojo back for at least the very short term, kind of building on the recent correction. But that is the only outcome that is favorable for the dollar. If we get in line with expectations or below, we are back to risk on, back to extended dollar selling. And actually, I think that would be the move that really kind of encapsulates a big downturn in the dollar if we do get another kind of weak or in-line inflation number, because it justifies what Paul was saying is that growth is good. We like growth, and growth coming back is okay if it doesn't, provide an impulse to inflation. And if inflation's kind of doing its own thing now and it's moving lower and we see disinflation for the next couple of months and growth is coming back, that's actually the best environment you have for undervalued global equities relative to the U.S. and a weaker dollar. So that seems to be, soft landing in the U.S. plus disinflation would be very beneficial for the weak dollar narrative, which we think is going to start to take shape again after this recent correction.
Mark, how do you play it? What's the best cross to play with that?
As we just mentioned, you definitely want to be long yen on that. So if your, inflation comes as expected, it's convergence of rates, Japan to rest of world. Other thing you'd want to think about as well, this is very bullish for emerging markets in terms of carry. So like Brazil, if you think about LATAM, if you think about Eastern Europe and some parts of Asia, India, Indonesia, Hungary, Brazil, Mexico, they're all carry currencies. They would all benefit from the disinflationary impulses and the shift towards EM exposure in general.